The way it's trading is it's on one account without any sub accounts. So it can only do one strategy per coin. However, when you trade it manually, or if you have two accounts to trade it with, then you can trade multiple strategies per account as well, which is something, I mean, you can do that on Binance, for example. You can do that. It's called a hedge mode. Uh, the the bot is just not doing that, but that's something I've been looking at um, recently as well, where we just um, update it to hedge mode, and then we can, do BTC bully and stock BTC, like multiple strategies, and Doge mainly, because Doge has three strategies that are slightly different. So if we just distribute that into three different strategies, the performance is going to be better. In general, it's better. This one has the Doge Moon Swing, but my favorite strategy on Doge is actually the Doge Strat, because it trades that often. And when we put together this bundle, right? You have the ETH Turtle, so you have the BTC Bully, right, which is a highly consistent strategy. That's the point of that strategy. When we just check it out here, I mean that's the whole point of that strategy, is that we're very, very consistent when we look at the equity curve in a sec. Then we have the ETH Turtle, right? So now we're attacking two more things. We're attacking another coin, which is a main coin, but it's different than Bitcoin. So if you have like a huge wick or something like that on Bitcoin, you don't have that on ETH, and vice versa. So you distribute there, number one. And then number two, the strategy, whereas focusing on very, very high consistency, it's focusing on trend following while being consistent. So it has larger moves, much larger moves. So this is BTC Bully. So you see how it just has these steps, right? These steps are here because it doesn't trade all the time, but like it's super consistent. It's like a staircase, right? That's what you want. With the 75% win rate. And the average profit here is 6%. Whereas when we go to the turtle, then this equity curve will look more aggressive, but the moves up will be much larger, right? So the moves up are much larger here. And that's why it's that profitable, especially when you compound. So and the average profit here is 12. So that's a big difference. And so we're attacking two different things, right? We're attacking consistency on Bitcoin, then we're attacking trend movements on ETH. And then we have our altcoins. Solana and FTM are kind of in the same bucket. And that's just if the altcoins start to move, that's what you want to catch. And you don't do that with one strategy, you do that with two strategies at the same time, in case one doesn't catch it, or catches it too late, or whatever, or is in the wrong side for a while before it turns around. That's why we have two, right? But when we look at, there we go, when we look at live trades, you see both of them are trading, and both of them actually have a very, very similar percentage right now. Keep in mind that this is spot, right? So when you trade, but leverage is much higher. And then you have Doge. So Doge has, we have two applications for Doge. One is basically the same thing as Solana and Phantom's doing. If we go to Solana, let's see, let it load. If we go to Solana, then, well, that's just highly profitable. This is on 1x too, by the way. So it's a highly profitable strategy. I love to trade it. Now when we go to Doge, say Doge Moon Swing, that strategy is between the consistency of Bitcoin and, still in an altcoin, right? So that's kind of what it's doing. When you look at the performance here, it has a mean profit of 47%. So that tells you all you need. It's this move right here looks like the ETH turtle movement, right? And this movement right here looks like the Phantom and Solana movement. So it's a mix between those two, and then also there's a clear period in time where the strategy doesn't work. The good part is though that doesn't work means flat rather than down, which is on most strategies. That's why this strategy is good. And then we have the Doge strat. And this strategy trades way more often, way more often here. But as it trades that often, it has a 69% win rate. So a very good win rate. And when we look at the descriptions in here for some reason, but when we look at just the performance overall, it's pretty consistent in getting those smaller moves here, which I really like to add into the index because it just gives you frequent wins, you know? And, you know, I'm not saying that like it has losses and everything. It has like every single strategy. No strategy can lose more than 20% in a trade, which is high anyways, but, you know, keep in mind that it's not 20% of the account, it's 20% off the allocation of 20%. So it's 20% off 20%, right? So it's not that big of a deal, which is 4% overall. So every strategy, the maximum it can lose is 4% of the entire account. And that might happen sometimes. For example, I would assume that this is a pretty big loss here. Let's see. This trade was what? January 2nd, right here, 8:30. Yeah, I lost 9% here. So because it started shorting here, and that short was good, but you know there was a loss, and I mean that's completely fine. It's part of the strategy. And what I like a lot as well here too is that many strategies, especially our stock strategies, that's probably the main thing that we're struggling with, or just, you know, in general when we're trading stock strategies, which is this, whenever the price starts moving down, right, it breaks the range, starts moving down, our stochastic just bottoms out and starts running around the bottom. So what that naturally triggers is a lot of long signals here that need to be filtered out, of course. Otherwise, you'd have a lot of losses here. And the Doge strat actually does the opposite. It does the opposite where it just keeps longing in a long move, which obviously makes sense, but that's something really good to see. So this is definitely something that I would add in. So Zebra, when you're trading this, the reason it's not in right now is because hedge mode isn't activated on the QC index account, so it cannot trade more strategies on the same coin. However, it would make sense to do that. So I would definitely add in the Doge strat if you're trading this manually, and it's also trading much more frequently than the moon swing. The moon swing is just there because it's much more consistent, you know, and you can see those strategies. Where's the strategy dashboard? Here you can see the performance of the strategies in the past few, I think past 2 months or 3 months. So you see that Solana and Phantom are on the top simply because we had those big moves, right? And the next are the Doge strategies, and then ETH comes in. So those are good to have, but keep in mind that they're much more volatile. That's why we also have 40% of our account trading more consistent strategies. And that combination together is what gives you this consistent results. So consistent results, right? Distribution is a big help with that. So yeah, let's just check what we have going on here. As we literally just talked about, we have a big move down. So let's see what the scalper is doing. The scalper is, you know, zoomed in enough to be able to profit here too, which is good. This is absolutely something that can be improved quite a bit, though. I might spend a couple a couple days on this strategy just to have it more efficient, because like these exits, for example, they could be much longer depending on what we have on the stochastics here. So yeah, when we distribute and when we trade our dashboards, it's important to understand, first of all, why those strategies are running and how they're running, but then also understanding how we can put those strategies together and why we put them together in the first place, so they work as efficient as possible. Another tip, which is very important. So when you put these strategies together, right, what you do is basically you distribute your risk. So when you play around with allocations and leverage, they should be evened out. And if they're not evened out, then you should be putting the allocations towards consistent sub buckets rather than just picking one strategy that looks the best. That's a big mistake that you can do. So number one is when you set the leverage, everywhere the same. So assuming that Solana is very volatile and Phantom is very volatile, the maximum leverage that I can use is based on those. And I cannot use a higher leverage here. Because if you do that, then you will put the allocations or the account sizes and the moves of your account, the unrealized P&L, you put it out of balance quite a bit. And then you'll get very volatile. So the reason why we have 5 strategies and they have the exact same allocations is because of that. Because when you start playing with it too much, you will allocate too much towards one strategy, which then defeats the entire purpose of distributing like this. So statistically, the ideal distribution is this. And then the more you start to skew your allocations towards one strategy, the more volatile you become. So when you're starting out, keep a very even allocation on all your strategies. If you add in the Doge strat, great. But you still keep them even. And the leverage that you should be using is 2x, maximum 3x. But 3x, a loss on Solana and FTM on 3x might already hurt quite a bit. So that's also something important to note. All right. So besides that, when we're looking at strategies, when we're looking at trading, following up on something that we were talking about yesterday too, is the mindset that many people suffer from when they try to make it when trading. And that mindset, it's not really their fault that they have that mindset, because they have been trained to have it, because most people need to have it in order for other people to make money in the market. But the way of thinking of how you make profits in the market is very skewed from reality. And the reality is this, like, the market's fair, where the market is fair. And the way the market works is that when you expose some risk into the market, right? So you put some money into the market. When you do that, then you get the chance to have some profits in the market, which are a fraction of the exposure of the risk that you gave it, right? That's how it works. You put in $10,000, so now you have a chance to make $1,000, and then you take it back out, and you take $11,000 back out. And you didn't interrupt anything in the market, you kept it in a harmony, because your collateral, like your fee for playing in the market, your collateral is $10,000. You put it there, you put it aside, you play to make $1,000, and then you take it back out. And nothing gets disrupted. However, when you're trying to trick the market, which is something that most people are trying to do, they're trying to go in with $1,000 or with $100, and they're trying to make $10,000 or $100,000 or $1,000,000, meaning that they put in a small collateral and they're expecting to get out of the market. They want, 100x of what they deposited, what the collateral was. And that doesn't work. And when you're trying to trick the market, it's going to punish you over and over and over and over again, brutally. And all your collateral is going to be gone all the time because you don't respect the fundamentals or how the market works in the first place, which is that you need a large collateral, or not a large collateral, but you need a collateral, and then you get a chance to take out a fraction of your collateral as profit. You put in $10,000, you have a chance to make $1,000. And with leverage, you can make it easier for yourself, yes. But what you do is you borrow collateral. That's not your collateral. So if things go wrong, then you lose that very, very quickly because you're over leveraged a lot. So leverage can help you, but it needs to be in a very, very thought through way. Because if you don't do that, all that leverage does is it pushes you closer towards liquidation. That's all it does. So, and this goes back into like institutional traders. They don't have to think about leverage, right? Think about that. You don't have to think. They never need to do any leverage because they just have unlimited funds. So whatever collateral is needed for that move, they just have it, they post it, and they make their money and they take it out. And there was no volatile disruption in the market. And yeah, like, so the move from taking your account from $1,000 and putting it to $1 million, that's an illusion, right? You can say that some people did it, yeah, but some people also win the lottery. It doesn't say anything, right? But it's not a consistent way of doing that. And that is the entire purpose of this community, is to find a way to make money out of the market consistently, right? And don't get me wrong, I'm not saying I want to make $100 a month consistently. No, I want a large sum of money out of the market consistently, right? Whenever we talk about percentages, I assume that those percentages are off of 100 grand, 200 grand, 500 grand. And if you're not trading with 100 grand, 200, 500 grand, then the problem is not like you're not trading with it because you haven't grown your account from $1,000 to $10 million, right? The only reason why you're not trading with it right now is because you don't have a proof of live trading history of consistent results. That is the only reason. Because if you had that, people would reach out to you, literally scout you like they do with athletes. I know that because that's what happened to us. So like people would just reach out to you. And the fact that you're in this Discord, there will be like more opportunities that you can even think of. Just based on the people, like just for information, like I'm working on a strategy with a client, and that client wants to use that strategy to start a hedge fund essentially, and that guy has like $30 million from different investors waiting for that strategy to be done. So there's so many people that just want, instead of their money just sitting in their bank accounts, they just wanted to have to work. So they're looking constantly for opportunities to invest money in, right? So the funds is not a problem. The problem is that you need a proof or just some live history data that you are factually consistent. Because if you're not, well, what this will look like, I mean, we looked at this yesterday. Sorry, let me upload something here. Beta 1. So if you're not, then it's gonna look like this. We're just gonna load up in a second. But if you're not consistent, if you just say you're consistent, and this is something very, very important. This is something that I've learned for a while, is that when you're in a Discord or when you're anywhere and there's people that are loud about their profits, about how huge their profits are, then usually their performance looks very much like the analysis we will just see. If someone's quiet about their profits and they're just consistently doing the same thing, not excited about it, kind of boring, that's exactly what you want to see, because those people make profit consistently. This is someone that's loud, right? This is someone that's loud. This is how, they'll have a good time, but they'll blow the account very, very quickly. By the way, this is live trading data. This is from a live account. So, and an equity curve like this, I see so many times, because that is the default mindset that people have. So, yeah, 1K to 1 million is possible, but so is winning the lottery. And the entire point of this Discord is to generate profits consistently. And how do you do that consistently? Well, we have our 3 pillars, right? Strategy, risk management, mindset, which is emotional management. So number 1 is strategy. We need to trade strategies that are consistent and proven to work based on basic fundamental principles in the market. And because of that, they will not change over the long run. When we have a strategy and we just, trade a random strategy that has been working the past month, well, we have no guarantee whatsoever that it's gonna work for the next month, or the next month after that, or tomorrow, or the next trade, really. Because there is no logical, using the scientific method, like there is no proof that the performance should continue the same way as it has been. And really what this means is that it will not perform the same way as it has been. Hope is something very, very expensive in trading. Very expensive in trading. Because when you're hoping for something, chances are, like to 99%, that it's not going to happen. Because when you're hoping for something, someone else knows that you're hoping for that. So exactly that is not going to happen. So consistent profits strategy, have a consistent strategy. The things that we teach: stochastic strategy, high win rate, because by default we're trading ranges, and by default you will be right more often than not that you're bouncing around ranges. Plus you have your alignments across multiple time frames that will tell you way more often than not what a price is going to go overall. So your trades will have a higher win rate by default, which will help you in your overall analysis or overall performance, really. That's number 1. Number 2, risk management. We need to understand that we need to understand how much we can trade or how much we can risk per trade. How do we do that? We look at our win rate, we look at our strategy. Really, anyone that sends me their live trading data, I'll do this analysis for you, and this number is exactly it. This person cannot risk more than 3.3% at any trade. Why? Because based on their win rate, it is calculated how many losses in a row are still likely to happen. And when that happens, when a bad case scenario happens, you still need your accounts to be healthy in a way where you can recover. That's the calculation of this. And here it's 3%. If we go to other analyses or something, some more consistent results, it will be 6, 7, 8, 10%. If you can risk 10% for in your per trade in your account, then you have very, very consistent results, which is very good. But you cannot risk more than this, and this is part of the risk management. And this, anyone can make this this calculation themselves. Really, it's just finding the probability, the probability P to get X amount of consistent. The probability P is 1%, and you're looking for the amount of consecutive losses in a row. That's your equation. And then you get it out, and whatever the amount is of consistent losses, you cannot lose more than 30% in that amount. So you just divide 30 by that amount, and then you have this number. For whoever wants to do this again, this will be recorded, so you can just replay it. So that's risk management, right? And then we have our emotional management, which is the understanding and the practice of understanding of how the market works, and that it's trying to emotionally trigger you. What is the absolute best way of trading? And I know that it might sound scary, but it's the best way of trading, and I've seen the best results myself and with other people when we did that, is to set up a trade fully, think about all the possibilities that may happen in that trade. Set up your logic and your levels based on that, so your entry orders, your exit orders, your stop losses, your take profit levels. Close the chart and let the trade play out. If you practice that, then you will, first of all, take much more time into planning out a trade and thinking about all the possibilities and scenarios that may happen, and thinking about solutions to those scenarios. And then when you play it out and it just plays out without you have absolutely no chance of going in and making an emotional decision within the trade, which is something that kills you many times. So it might be scary, but if it is scary, it's just because you haven't thought through all the trades or all the possibilities within the trade. So that's a way of making sure that you will not mess up the trade with your emotional triggers, which that will happen. And you will also plan out the trade more, and by definition, you will not enter low probability trades, because the calculation in your head, or the planning out, will not look that good. That's something that we have seen many times. That's something that this person actually struggles with, which is that just because the win rate is very low and the risk to reward is very low, what this means is that this person does not enter the right trades. They enter trades that are not a good deal, right? So that's our risk to reward. They're not a good deal, so they don't enter a trade, at the bottom, or they don't expect the price to come to them and fill their orders and have a very, very good average entry. They don't do any of that, for sure, number one. And then number two, they don't look at enough confirmations to do that trade. I'm sure what they do is that they see a big move or they see a big candle and they FOMO in. That's what they do. And sometimes it works and sometimes it doesn't. But the thing is that if it works, it works. But if it doesn't, you will lose 80. If you make 80%, you make 80%, right? But if you lose 80%, you only have 20% of your account. And it does not matter what. So if you have 100% of your account and you make 80%, you have 180%. If you lose 80%, you still have 20% of your account, right? So the losses are much more significant than your wins, especially when it's a big loss. And that's why a big loss like this can only happen if they don't plan out the trade. And if people in here, if they have problems with over trading or over leveraging or revenge trading, the solution to all those things is planning your trades out ahead and then closing the chart. Because you will not close the chart if it's not played out, if it's not planned out enough. There cannot be any possibility where something happens that you did not expect. You either hit your stop loss or you hit your take profit levels, or you just stay in the trade. There's no other options. But then if you're not in there and you just look at it later, you will not revenge trade because you were not in that trade. You will not try to still catch the move or try to catch the next reversal, try to catch a falling knife or whatever. You don't do that. Number one. Number two, you don't do anything or any dumb decision within the trade, because we always look at played out charts. We always look at historical data, right? However, when we look into, when we would look at it live, there's a lot of movement going on. Even when you have a big pump here like this, and you're looking at it live, this red candle is scary. This green candle is even scarier because it had a wick here. So imagine this candle closes red. Now what happens is you have another new candle and it starts dropping even more. It dropped all the way here. So at one point, this candle was red up until here. From here to here, it was a big red candle. Guess how many people exited right here in their long? A lot of them. Or guess how many people shorted here? A lot of them. And guess how many people got stopped out and liquidated here? A lot of them. Just because they were in the trade live. Whereas if you would just set up your long here, put your levels based on your analysis before, and then leave, and then you would come back when the price is here and you just look at it historically, you'd be like, oh, I did a good job. I don't even think about this candle here right now because I wasn't here when it happened. Right? So that's a very, very good way of protecting yourself from the emotional triggers that the market wants you to feel, by not being there, because then literally you cannot feel that. And when you think about, oh, it might not be responsible for me to leave when the trade's going, no, not really. You can set up your orders. You can set up every single cent of your position to be taken care of, no matter what. You can set up your take profit orders. You can be more conservative too. You can risk less if it's bad. If you're trading and you're stressed out about hitting your stop loss, you are over leveraged. You are overextended. You're trading with too much money for yourself, right? How do you solve that? Well, first of all, think about consistency, and then second of all, get funded with a large account, and then you will not, I promise you will not feel that way. So 1K to 1 million is an illusion. It's like winning the lottery. Some people do that, but it's not a consistent way of doing that. If you would just focus on consistency, you'd make much more money than the person trying to get to $1 million, because that person is going to, first of all, blow their account, guaranteed, many times at some point, right? And they might think that they are making money. On paper, they're making money. Unrealized, they're making money. Their account goes up, right? But all that means is that they just entered a little bit earlier than other retail traders. But it's not their money, and they will never get that money. That money is there for a payday for institutional investors, because institutional investors were trading based off of a consistent strategy always based on a consistent strategy. And that strategy has you as exit liquidity. So when you enter in and the price goes up 20 times more, and then your account a couple days later is at $1 and all that money is gone, you were just exit liquidity for institutional traders. That's what it is. So the only consistent way of making money in the market is by, well, guess what? Being consistent. And how do you do that? You have the three pillars in check, which is you have a strategy that's robust, right, and consistent. You understand risk management, and you know how much you can risk per trade. And it's not just, okay, I will be okay if I risk with this much. No. What this means is that you understand how much you can risk per trade to, number one, reach your goal, and number two, not blow your account so you can still reach your goal. And that's an understanding. That's a skill to be learned. And the same thing is with emotional management, which is finding mechanics and techniques on how to make sure to execute your strategy exactly how it should be executed without you going in and messing up the strategy because of your emotional triggers. So those are the important things. And if you just focus on consistency and you trade with 100 grand or 500 grand or whatever it is, and you will if you have the consistent results. You just need the consistent results. And our challenges are proof of that, right? Literally proof of that. If you have consistent results, you will have a six-figure account. That's literally the definition of that challenge. And the market's fair, right? Whereas people might think it's not, it is fair. If you think the market is not fair, it's because you're trying to trick the market rather than trying to work with the market. Which is that you need to add in risk, and if you do, you have the chance to make some percentage of that risk back. That's the rule. You put in $10,000, you have a chance to make $1,000. If you're trying to trick the market by putting in $100 and expecting $5,000 out, you will get punished for it. You will get brutally punished for it, and it will hurt. And the biggest tragedy is that people will just keep doing that, just keep gambling, rather than understanding that that's not a way, and focusing on trying to learn a skill of trading consistently. So you're trying to trick the market, risking $1,000 to trying to make back $1 million, and the market will punish you for that. And you'll do the mistake over and over again. So that's a problem. And you might see a large number on your account, but those are not your profits. That's just there on paper, virtual. It's not real. If you would have taken it out, then it would be real, but if you would also, trade consistently, you would make a lot of money. Those are all just hypotheticals. You didn't, right? And it's not an accident that you didn't. 99.9% of people didn't, and there's a reason why they didn't, which is that they don't understand how the market works. So the rule of thumb is that if you have a disproportionate return, meaning that if you have a large multiple to the amount that you risked, it is an outlier, and you need to take profits. You need to take profits out because it is an outlier. Those outliers can happen, and the reason they happen is so other people go in and buy more. So it's essentially collateral damage for institutional traders that you will see a large amount of on your account. But if you do that, you take that money. You take that money. If you don't, it's going to be gone. So, So it just means that you enter a bit earlier than some retail traders, but this won't change the fact that you won't realize it unless you have a clear strategy on how you're trading. Your strategy can be geared towards coins that pump a lot, for example, in crypto, right? That absolutely can be a strategy, but every strategy has an exit time and an exit condition. And if you don't have an exit condition, that's a very, very, very big problem, because you will lose that money eventually, right? So that's how consistency looks like. Consistency looks like understanding that you need to put in an amount, and then you can take out as extra profit a fraction of that amount. And if you engrave that in your brain and you do that consistently, you will consistently make money. There will not be huge days and huge losses. It will be all consistent, right? It will be consistent. It will be predictable. You will know how much money you can expect at the end of the month. And then, if you have that, all you need to do is just add in a larger account, which will happen very quickly and very easily. And then you will just 20x or 30x or 100x your profits, because you'll 100x your account. So and that is the profitable way of doing that. And that is how basically every market, like, do you think on Wall Street, right? Goldman Sachs, BlackRock, whoever's trading, large institutional traders, do you think that they would ever try to turn $1,000 into $1 million? Never. It does not make any sense whatsoever. They trade with large amounts to make fractions of those large amounts, which, by the way, are very, very high amounts, right? So that is something very, very important, and that is something that once that clicks in your brain and you start looking at your trading in order to build an asset, it's the same in business, right? It's the same thing in business. When you're trying to make a quick buck, or you're trying to, back in the days in drop shipping, right? All you try to do is, scale up a shitty product to make 10 grand a day, and all you're trying to focus on is 10 grand a day. Maybe you get there like one day, but it is guaranteed that something will go wrong and the whole thing will crumble, leaving you in debt most likely. Whereas if you would just focus on building your skill on marketing, and so the reason why you're trying to hit a jackpot product is because you know that you don't have the skills to do it consistently, so you're trying to catch a break and get an outlier. But that's not consistent, right? The consistent way is to learn the skill. In e-com and dropshipping, it was marketing and buying ads, literally what it was, and then maybe negotiation with suppliers, and then taking that and getting a consistent system out of it, and then that's when the money comes in. Same thing in trading. You want a consistent system. And it does not matter if you're trading with $10 or $100,000. It needs to be a consistent system, and then the money will take care of itself. So the main focus needs to be on every single trade that you do. The main focus needs to be on, okay, how do we trade, and what strategy do we trade? Are we trading exactly according to the strategy? And then, does the strategy work in this scenario or not? And based on that, can we expect consistent results in the long term? And then when we do, we just keep doing that. We build up a live record of our performance, and then you can take that as an asset, same way you can take a business as an asset, or a painting as an asset, and build the leverage. So understand it this way. When you build, or like when you create a life trading history of consistent results, you are your net worth just increased by a lot. Your net worth just increased because you have that history. Think about that. That means that every single trade that you're doing, you are making money. Just not off the market, but you are making money in your value, in your net worth, and you're pushing your profits off into the future, which then lets it to be leveraged. So as you do that and you build an account with live trading data that's consistent, you suddenly have an asset to a point where people will beg you to give you thousands of dollars, hundreds of thousands of dollars, depending on how big the history is. And then if you just keep doing what you were doing before, you will every single month you generate tens of thousands of dollars, or hundreds, depends on the account. So and that is the most consistent way of doing that. Because you trading with $1,000 or $5,000 or $10,000 and trying to make a large amount this month, next month, all that does is you're over risking and over leveraging, and you are just waiting for account to be blown. Whereas if you would just focus on the skill, you would actually build asset value. Asset value as in you have consistent results, and no matter what happens, you have that report, you have that live training data. So no matter what happens, you are worth that amount. Someone will give you that amount, no matter what. It doesn't matter if Bitcoin goes up or down, you are worth that amount. And that is how you build wealth in trading, by owning assets. The dashboards, they're an asset. What they're trading is an index, right? It's an asset. And you can sell the asset, you can leverage the asset, you can get investments and funding for that asset, right? Because it's an asset. It's not us running around like crazy people trying to make 1,000% in an hour and blowing our account 5 times. It is a predictable way of consistent returns. And that's why it's an asset, and that's why it's interesting for investors. All right, so that's everything I wanted to cover today. I see your question. Let me check. So essentially, we'll be trading what we are expecting unrealistically, not what the market is showing, right? Making it hard to take profit and being okay with staying in and taking drawdown thinking is part of a process because it was in profit before, and therefore normalizing the losing process because you don't have an exit plan. Yeah, exactly. So you will, by lacking the initial plan, and you're lacking the initial plan because you lack the fundamental understanding of a market. Because of that, you will create a reason why what you're doing is correct, and you will keep reinforcing that reason over and over and over again, and you'll feel good about it, and then you look at your account and it's gone eventually. Because you keep explaining to yourself, you keep justifying the losses, where there is no reason to do that. If you had a loss that's too big, it means that you were overextended. That's the only reason. You were overextended. You were over leveraged. It should not hurt you to be trading. You should be trading, trying to get consistent, and then when you're ready, the money can flow in. And when it flows in, you will still make the small percentages that you did before. It's just a larger amount of money. But because it's a small percentage, nothing can happen to that account. Because, if you even have 10 losses in a row, it's still a very, very small loss compared to the overall account. So you can trade with the same amount again. You did not just lose 90% of your account. So to get back to, right? So like when you lose 50% of your account, you need to make 100% of your account to get back to where you were before, to get to break even. Because you only have 50% of your account. If you trade with small percentages of your account, you can trade with the same amount every single time. On the dashboards, we trade with the same amount every single time. If you lose, you still trade with the same amount because we're taking a fraction of the overall account size, right? And then those strategies are just the workers on the overall account, so this overall bucket, and the bucket grows and grows and grows. So there's only, something to, even if an account, which is not going to happen, right? But even if a strategy would blow their entire balance, they could just reload that balance because the bucket is there. So there's no situation where we lose 50% and then we need to make 100% to get back to break even. That just does not happen here. The physically cannot happen, which is also a very important point. So yeah, good question. Yeah, if you guys have any other questions, let me know. Other than that, this will be on YouTube. And there are some great things coming in the next couple days. I'll update you about those. And other than that, I'll see you guys in the Discord.